Hello, since many of you have asked me questions about the homework assignment, which is due today, I thought I'd make a quick video and show you how to work through this assignment. So let me start with a quick screen share as usual, and let's take a look at what we have. Okay, so to start with, let's do an overview of the relationship between inventory and cost of goods sold. Beginning inventory plus everything you purchased is what's available for sale. Well, that makes sense. Now, during the year, I hopefully sold all of it. If I sold it, it is going to become cost of goods sold, that cost. If not, it sits with me as ending inventory. Our job in this exercise is to assign the amount of what we have available for sale to these two accounts, cost of goods sold and ending inventory. So let's take a look at the assignment we have over here. So here we are told we have Parker Games that has the following inventory transactions related to its traditional board games. On Jan 1st, it started the year with 120 units of beginning inventory. Again, remember, this is the units on hand. They had paid $21, so their cost is $2,520 for that inventory that they brought from last year. Then during the year, they made two purchases of 90 and 60 units. So they have a total of 270 units available for sale. The total cost of the units available for sale is $4,500. They're telling us during the year we sold 170 units, which means of the 270 available, if I sold 170, I'm left with 100 units. That's what's left with me. So I've written that down over here again. What I'm left with is 100 units because I sold 170. Okay, they're asking us to use FIFO in calculating ending inventory and cost of goods sold. LIFO to repeat the same exercise using LIFO. And then there's a third thing they've asked us to do over here. Let's first work on FIFO and LIFO, get an understanding of that real quickly before we move on. Okay, so to start with, what does FIFO mean? FIFO is first in, first out. Okay, so what this means over here is whatever I had available with me in the beginning, that's what I sold first. Then I dipped into the first purchase I made during the year. So I'm going in chronological order. And what stays with me is the ending inventory. Okay, so here what I've said, we'll move this slightly onto the side here. Okay, so we sold the oldest inventory first. And what is remaining with us is the most recent purchase. So the best example is perishable goods such as groceries. Whatever you buy, you try to sell that first. You don't want to keep that sitting around. So I had 270 available. I sold 170. So what did I sell? I had a choice of selling from the 120, 90, and 60. Obviously, what I sold was a 120. I started out over here. So another way of doing this is my focus is going to be on this ending inventory. It's easier to look at the smaller number. I have 100 units left. Okay, so I'm working with this 100, these 100 units. And what I'm saying is what I'm left with is this number, the 60 I'm left with. It's all still sitting with me. That's not gone. Okay, and that was $9 per unit. Then I have 40 left with me, which is the 100 minus 60. I'm going back and saying, and that came from this purchase. So of the 270, 170 was sold, which means this 120, all of that was sold. I got rid of that. That was there from last year. I got rid of that first. And then I took from over here 50, which means 40 is remaining over here. When I multiply these numbers, I'm saying that my ending inventory under the first in, first out method is 1,180. As opposed to that, we have the LIFO method. LIFO stands for last in, first out. Again, I have the same situation. I have 120 I started the year with. I have 90 more that I purchased, and then another 60. Last in, first out says, I sell this first, and then I sell this purchase, and then I go back to the very old inventory. So here what we're doing is we are saying we sold the most recent purchases first, leaving the oldest purchases still in our warehouse. So what would be a good example here? Anything that's technology related or seasonal fashions. The reason companies do this is because for those items, they get the highest price when they first buy it. So for instance, right now, I think spring is too late. They already have summer fashions out there. Right now, whatever you find for that price, that item, by the end of summer, that price has dropped dramatically. So they need to sell whatever they get new, they want to sell that immediately. Same thing with technology, things like your phones, computers, etc. Same thing goes over there. Okay, come back to what we have to deal with over here. We are still looking at the same thing. We have 100 units. Okay, now in this case, I have 270. If what I got recently is what I sold, everything is from this 120. So I have that 120, 100 still remaining, and that's $21 a piece. Now think about it. I started last year with 120 units that I paid $21 a piece for. At the end of this year, I still have that same inventory from the year before sitting with me. That's 100 units at $21 a piece. Anything that came in first, I've sold that out. This old inventory is still sitting with me. It's extremely problematic for companies when they use the LIFO method. But again, depending on the inventory you have, it may make sense to do that. Okay, so in this case, this 100 units, if I'm using the last in first out method, I'm saying it is $2,100. I've assigned the cost of $2,100. Okay, let me go back again to the problem and look at part 3. Because of the increasing popularity of electronic video games, which probably has been happening for many years, Parker Games continues to see a decline in the demand for board games. Sales price have decreased by over 50% during the year. By the end of the year, Parker estimates the net realizable value of the 100 units that are unsold will be $500. So what they're telling us over here in the net realizable value, this is the net realizable value method. They're saying this 100 units that I have on hand over here, it's the same 100 units we're looking at. What they're saying is the best I can possibly do is sell it for 500. It doesn't matter what my internal accounting is. The best I can do is sell it for 500. So in this case, they're telling us we need to find out the ending inventory to report using the lower of cost of market under the FIFO method and record any adjustments. So they're saying I was using the FIFO method first in, first out. I had 100 units on hand at the end, and I said it was worth 1,180. That's the cost I'd assigned to it, the first in, first out. So I was doing a good job of getting rid of all that old inventory. So the most recent purchases are sitting with me. That's at 1180. But now I'm saying, I'm going to put this in a different color over here so we can see this. I'm saying this, can we see this color? Yeah, sure. Okay, so I'm saying it should not be 1180 in my books. It should be only 500 in my books. That's what it should be. It should not be 1180. Okay, now I cannot magically make a number change. Okay, so what I need to do is an adjusting journal entry. So my adjusting journal entry, I need to decrease my inventory value. This is the dollar amount from 1180 to 500. So I will debit cost of goods sold and I will credit inventory. Remember, inventory is an asset with a normal debit balance. I'm crediting it because I want to decrease its value. And how much do I want to decrease it by? 680. How did I come up with that 680? In my books, it's 1180. I want it to become 500, so I have to credit inventory 680. That's what I need to do. Okay. Now, going back to the problem on hand, they asked you, using FIFO, calculate ending inventory and cost of goods sold. We calculated ending inventory. So my ending inventory number is 1180. Under FIFO, ending inventory is 2100. We calculated that number. Net realizable value method, ending inventory is 500. They gave me that number. Okay. Now, last part is, what do I assign to cost of goods sold? What will that number be? So for that, I'm going to go back to this. Let me see if I can bring that up here. Yep. Okay. Beginning inventory plus purchases is cost of goods available for sale. I either assign it to ending inventory or cost of goods sold. Now, what we have worked so far is I know how much I'm assigning. I'm going to put this in a different color so we see this. I know how much I'm assigning to ending inventory using each of these three methods. That's what the exercise was. Now, the last part is how much to assign to cost of goods sold. Cost of goods available for sale. This number over here. Cost of goods available for sale. The dollar amount is 4,500, 4,500. Okay. Under the FIFO method, if I assign 1180 to ending inventory, how much should I assign to cost of goods sold? 4,500 minus 1180, I should assign to my cost of goods sold. Okay, same thing over here. Under the LIFO method, if I assign 2,100 to my cost of goods ending inventory, how much to assign to cost of goods sold? 4,500 minus 2,100. That'll give me my 2,400. Net realizable value. 500 has been assigned to ending inventory. Therefore, cost of goods sold should be 4,000. Again, now one thing I would suggest is just to check if you're doing this, you've done this correctly. Just add up these numbers and see what we come up with. Move this up a little. It has to be 4,500. You can do it for each of these numbers, each of these methods. It has to be 4,500. The point over here is I had beginning inventory plus purchases at 4,500. That is what's available for sale. That 4,500 I'm assigning to ending inventory and cost of goods sold. Pay attention and see which method we're using, first in, first out, or last in, first out. We went through the motions of doing the calculation. Again, remember, first in, first out, our oldest inventory is being sold first, like groceries. Think about milk. If I have milk, vegetables, any of those things sitting for too long, they're going to go bad and I have to throw it. I don't want to do that. So I want to move all the old merchandise first. That's a first in, first out. Last in, first out, whatever I bought, that's the one I'm selling first. Technology, fashions, those are good examples. Regardless of which method you use, in the net realizable value, you're saying, let's stop and think about this at December 31st. Doesn't matter which method we use. Does this make sense? If my market value is way below what what I have it in my books, I need to adjust my books. Now, if it's above, I don't make any adjustments. So if my ending inventory is 1180 over here, as I've said, if I expect to sell it even for $1 more, I don't make any adjustments. Or even at cost, I don't make adjustments. I make adjustments only if it has dropped. So if I can sell it only for 500, I should not keep it as inventory in my books at any number above 500 because I'm misrepresenting. Someone looking at my financial statements, they're going to say, oh, you can sell your inventory. Your cost is 2,100. You're going to sell it for more than that. The answer is no. I think the best I can get is 500. Okay, that is the reason we do this adjustment. When the company sees that the value of the inventory has dropped below cost. If it goes below my cost, we're not talking about selling price. Okay, hopefully I can sell it at a higher price. But when you look at a variety of items, you need to be realistic. In this example, it's board games. So I hope this helps you work through your homework problem. I will be waiting to see if I have any emails coming through.